Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everybody, Steve Waters and Victor Kumar from Right Property Group back again for another film version of Investing Insights. And it's been a couple of weeks.
Yeah, it's
literally since we've done this. A couple of Facebook Live events as well, and another podcast. And it's been a busy fortnight. So many things have changed once again, but they've also perpetuated. We'll get to that in the minute. But let's start off with today's subject, because I think it's a really apt one, not just because it's this time of the market, because it should always be at the forefront of our mind, but more so because people, I think, are going to tend to forget about it. And that is finding that balance between growth and cash flow. What's that inflection point where everything is balanced? We're not concentrating on one aspect too much more so than the other, because whilst in principle it sounds like a good thing to do or a rewarding thing to do, somewhere in the future you'll be caught. So balance between growth and cash flow.
Yeah, and so we're not talking about just the one property. We're talking about the entire portfolio and taking into account today's market.
It could be potentially the entire portfolio, or it may be one property, because some people only want one.
That's right.
And we'll be pretty general in the way that we look at it, but essentially we're just after balance for today's market, but more importantly for the future, which gives us that sustainability. But we'll get to that in a minute. Vic, what's been happening? Let's have a market update.
Yeah, we haven't done that for a little while,
It's
have
been
we?
a while.
Yeah, it's been a while. And
it's a different market than it was.
It's a different market altogether.
This time last year.
Yeah. This time last year we were talking about, how far the market's going to go down. And that's what most of the economists were saying. We weren't.
No.
Yeah. And it was all doom and gloom. And slowly but surely the rhetoric started to change until suddenly, all of a sudden, the switch was flicked, and instead of going, it's going to drop by 40%, 30%, 10%, it climbed back up to say, actually, we might get some growth. And then it became, actually, it'll be 5%. Oh, no, it's 10%. And now everyone's saying, no, it's going to be double-digit growth this year, right?
I've heard up to 20 and 30.
Yes.
Which I don't buy into, because if it happens, it's a bonus. But you know what I'd really like, and if any of the listeners out there have this stat or this data point or have the capacity to create it for us, I would love to know from February last year through to, let's call it September last year, how many negative pieces of media content there were versus positive, and then what is it today? So let's call it from September last year or October last year through to today, how many negative versus how many positive, and there'd be 180 degree.
Yeah, and it's all driven by media, right? One person makes a comment, and they are interpreting a data set on its own right then and there, and say, okay, this is what it's telling me, right? So, and everyone picks up on that. And an interesting exercise would be, Steve, is to go back in history, right, and look at every time there's been negative sentiment in the media, did it pan out as per prediction?
Yeah.
Right? And every time there's been a positive sentiment in media, has it panned out that way?
There'd probably be some instances where some of it was remotely correct, and I cast my mind back to say when APRA pulled the handbrake.
Yes,
because
that was predictable.
That was a pretty obvious scenario. But in this instance, around COVID, I think it was more reactionary opinion versus well thought out knowledge or opinions as such, because there was nothing really in there other than the obvious, which was going to change dynamically the trajectory of the market or where the market was at that point in time. The steepness is a little bit amplified, to be fair, but you could essentially call it at the moment a two-tier market, attached and not attached, or houses. And clearly those inner city areas are struggling, and they will continue to do so. But for me, that's what the media were
latching onto,
and then generalising, well, that's going to have an effect over the whole market, what we're seeing on those inner city areas.
Yeah, in fact, I read an article this morning where they were saying that it's been the fastest and the quickest period that people can get their deposit together. So this is talking about first-time buyers. And they're giving examples of, say, Sydney prices dropping by $21,000 to $29,000, right? Show me that. Show me that.
Yeah, whoever that person is,
Yeah.
do you want a job? Go find those properties for me.
Yeah. See, as Australians, right, this is where our love for property, right, and this was being thrown around flippantly way before, right? But true to form, this is a product of our resilience and our love for property in inverted commas, because we are all working towards some level of betterment of our lives. Now, whether it is you're taking an approach of tax minimization, which our stance on that is pretty obvious, or whether it is actually wealth creation as such. Yeah, given that finance is so cheap, money so cheap, finance is relatively easy to get in comparison to 2019. And the fact that we are saving a lot of money because we can't go abroad for our holidays and all that sort of stuff, the natural thing is to either put it in shares or property. And generally with the tangibility and the market hype that's building up, good and bad, people are jumping in left, right and center. And that's one of the reasons why we thought we'd talk about growth and cash flow and making sure that there's a balance there.
Yeah, because as I said earlier on in the introduction, that people are going to very quickly forget about either component. There'll be those that are in the camp of wanting to chase cash flow and make money while they can in terms of that position, because the rates are so low and there might be a high net yield or gross yield, and that gap. But there'll be the other camp as well that'll be saying the cost of money is cheap, my cash flow position is doable, I want to ride the growth gravy chain as it will be. But somewhere in the middle is that optimum position to exploit. And I say exploit quite deliberately because it's what you do now to set yourself up for year 2, 3, 4, 5, 15 rather than the now.
Yeah.
And to be fair though, if we get amplified growth well and truly above averages in certain areas, we'll take that. But it's not. We don't rely upon it. We know it's not consistent, and average growth periods are average growth periods for
so
a reason.
No speculation.
Well, no speculation, but no speculation around your own position.
Yes.
Now, and there's a big difference between speculating around your own position versus being tactically aggressive.
Big difference.
To take a moment in time.
Yep. Because this is this could set you up for generational wealth if you play it right, because the markets are all lining up as such. But this is also the position where a lot of people can get financially hurt if they don't have a planned approach and they don't look at the worst case scenario first and then jump in feet first, because the media is saying or someone in your circle of friends has bought in an area and done really well. It needs to come back, like we say in every podcast, it needs to come back to your own financial fingerprint and make sure that you address that first before you look at even buying anywhere or even start looking at areas.
So before we get to that, let's do a market update
on
what we're seeing at the moment. And I'll kick it off. with, I'll take half the country, you can take the other half. How's that?
Divide and conquer?
Yeah. So I'll start off with where we are today, which is Sydney. And the market turnaround in terms of consumer sentiment has, I'm not going to say it's been immediate because it was already there. You go back to June last year. It was already starting to turn there in terms of that confidence piece. And we often talked about high search intent data points, and it was massive back then. It was bigger than it was 12 months before the crisis. And people have done very well between now and then. And some of the areas that have done well within the Sydney corridors is around those existing houses with a piece of land attached. So I'm not talking about house and land package. I'm talking about existing property with a land attached components. Central Coast, South Coast, those commutable distances have done extremely well. Probably more so than any other corridor on a pound for pound or percentage base scenario. But the data won't reveal that yet. It'll be another couple of months before you start to see those data sets come through. And Sydney continues to move forward. The buyers agents were coming back to me on Monday morning, giving us the intel from the weekend, and properties that had price brackets of, one in particular, had a price bracket of between 640 to 660, and it went for 740 on the day. 75 people through the open home, multiple bids. I'll call them bids because it was almost like
it was almost like a Dutch auction, wasn't it?
And the agent was in their prime. This is what they live for. They love this. This is their sport, dare I say it. It's been quite a while coming for them.
Yeah.
But that's an image, if you will, of the entire corridor.
That's right. And one of the things that we see historically around this time and this phase of the market is there's a lot of new agencies that start up as well, because a lot of people that have been sitting on the sideline, they say, okay, no, I can hang my shingle and start a business because it's easy to get a sale because there's a lot of buyers, but they have to get the right listing to begin with.
They have to, and listers are winners in their world because you can't sell what you don't have.
Yep.
And we can't buy what doesn't exist, which brings me to the point of the Sydney Greater Basin area. And I think I might have mentioned it last podcast or somewhere, that it's as skinny a market that I've ever seen. Now, I noticed there were some media points out there. Someone took exception to that and said, like one of the property reporters said, yeah, but the data shows that we're in a really strong listing period. There's a lot of property for sale that's just transacting quicker. And they're kind of right, but kind of wrong. And I'll give you an example of one particular area where usually there'd be 6 to 7 pages of property for sale. That same suburb today has 7 properties only, not 7 pages, 7 properties only, of which 4 are under contract, and 2 of the other 3 are bait advertising. They sold some time ago, and there was 1 genuine for sale. Now that's a very skinny market. That's an illiquid market on the buyer's side, but it's an extremely liquid market on the seller's side, which is something that we've always talked about as one of those points of mitigation is you identify the liquid markets, not the illiquid from a selling point of view as risk mitigation. So that's Sydney, very, very buoyant, all the way down to the coast and all the way up the coast. And I won't really touch on the regional areas because they're a different beast again, and they're all perpetuating because of what's going on. Into I'll do Brizzy. You can do Melbourne. So Brisbane, north, south, east, and west it's just crazy there as well. Well located properties with good dynamics around them are doing very, very well. The rental market is running away as well. So we've seen very, very big growth on that.
And one of the things that we're finding is that some property managers aren't keeping up to speed with how the rental market is shifting. So the advice that you get from the property managers, you need to jump online and see what comparable properties are renting for if you're looking at renewing your leases.
It's a good point, but be very careful. Go a little deeper than that, in my opinion anyways, because often a lot of properties are listed for rent that either aren't for rent or they're being listed pre-vacancy.
Yep.
So a tenant might have given a month's notice or whatever it may be. So ring up the agents in the area and then collectively find out how many properties they manage and then how many are legitimately vacant. And it could be a different story.
Like physically vacant.
Physically vacant, because that will give you an up-to-date picture of where the market sits at that point in time. But a lot of those Brisbane corridors are sitting maybe 1%, but some are below, which is an extremely tight market. And bear in mind that when people talk about vacancy rates, 3% is that point of equilibrium is the general rule. So it's enough supply for enough demand. You get to a 2% market, vacancy rate, it's a very, very tight market. You get to 1% and it's just incredibly tight, where tenants start to pay more than the asking price
to get the property
and prepay in advance just to have that point of difference to secure the roof over their head. So how about Melbourne? What's Melbourne doing?
Well, Melbourne, it's slightly out of step from the other states because of its rolling lockdowns it had, right? So it's got a little bit of a gap that needs to catch up to. However, it's got the same problem that every other state is, that there just aren't enough listings on the market, right? Both regional and metropolitan areas are doing phenomenally well. I'm talking about the detached housing, of course. True to form, the inner city area is suffering a bit, both from the rental point of view. I think that's all states. And also from a sale point of view, because people are now saying, okay, I can go a little bit further out and get a house, or I can get something with a little bit of land on it. So that's the market itself. It's been buoyed up by the stamp duty concession that they've got. So if you are buying an established property below $1 million, get 25% off stamp duty. And if it's brand new, then you get 50% off, regardless of whether you're an investor or a homeowner. So certainly that's helping people get into the market. The reality is that it's like any other market in terms of supply and demand. There just aren't enough good investment properties around.
investment grade, not
Yep.
investment stock, which is a big difference, as we've pointed out before. And the whole East Coast is pretty much the same. So if we even go into the ACT, whether we go into South Australia, that's the picture
Yep.
of the market, is there's just a lack of stock on the market. However, there's also an enormous amount of potential purchases in the market as well. Like if we go back to that media narrative earlier on in our conversation, how it's switched very, very quickly, it's getting to a point, whether you believe it or not, it'll become self-fulfilling.
Yes. It usually does, doesn't it?
Well, it does.
Yeah.
If the weight of opinion is one direction or another, it has that tendency to be self-fulfilling, as we just mentioned. But Melbourne is no different, or Victoria is no different. Some of the regional areas versus all the way through to those corridors in and around the CBD. And I agree. I think it'll be some time yet that those units start to recover.
Yep.
But having said that, someone asked us the other day, do we still buy units? And the short answer is it depends. And it depends.
Needs to make sense in the portfolio and needs to make sense
Correct.
as a investment purchase to begin with.
Yeah, and even more so if I have the choice, if I can buy the entire block.
Yeah.
So I control everything from the potential strata to all premises to the entire land content. That's when it becomes very, very attractive. And the problem with buying blocks of units in today's market, no matter where it is you're up against the listed and unlisted funds who have much deeper pockets. Usually there's a really sweet spot in blocks of units between, if you can get somewhere in the vicinity of, still in the resi space, 4 to 6 pack as such.
That's the closest you'll get to a 6-pack anyway, isn't it?
It's wrong podcast. It's somewhere between a 4 and a 6-pack. It's almost too big for the little person and too small for the bigger player. So there is a sweet spot there that if you time it perfectly and you are in that resi space in terms of lending, it can be quite lucrative for the future. Yeah. So what about South Australia?
Look, South Australia it's like Thomas the Tank Engine. It just keeps chugging along. It keeps chugging along. Even during the GFC, it went upwards. Certainly, there is a lot of momentum in the market there, but it always has been. However, the growth trajectory when you compare it to your larger states population-wise is a lot shallower, and we need to be really mindful of what we buy there. But the unit market, again, there in a city is suffering, as per every state. Housing market is pretty buoyant, pretty strong. We're finally starting to see movement in some of the traditionally oversupplied, low growth areas, like Christie's Beach as an example. Definitely movement there. And I think from a purchasing point of view, you do well if you buy there. Finding the right investment, again, is a challenge.
Yeah, and that's a good point, because we also need to be very very wary, more so, is some of those areas, not just South Australia, but throughout the whole of the country, seem attractive now. And they are attractive now, and they are producing now. But if we go back historically, they do have those moments in time where they do, but then there's a period of nothingness.
Then they sleep.
Yeah, they go to sleep for some time, and whether that be from a cash flow component or growth or a combination of both. So depending on the risk profile or your risk appetite and the type of investor that you are, will determine whether you go into those areas.
Yeah, absolutely.
Or not. So let's talk about WA, Perth. And it's had a massive turnaround.
Yeah.
And we mentioned this last year.
In fact, just before lockdown, when we did that Facebook Live from the car, if you recall.
On the way to the airport, because I think it was the last plane out of Perth.
Yeah, that's right. Yeah. We predicted that there'll be a fairly strong upswing in Perth.
And you're starting to see the data track upwards. So we already know that their vacancy rates are very, very low. There's a few other little bit of pieces of information people need to understand about Perth and the rentals, the moratorium up until March, and whether that stops then or not, which we'll go into a bit later. But the growth has started to happen, especially for the well-located areas, say maybe to the north and south, have done very well. So the areas that are, in my opinion anyway, more owner-occupied than investor-driven.
Yep.
because those investor-driven areas, people are in and out. It's a transient market.
That's true.
So to speak, from my point of view in terms of its value proposition, but those owner-occupied areas where it's circa 60 to 70 to 80% of owner-occupiers versus tenants have got very, very strong demand, like very small days on market.
Yeah.
Really small days on market.
Yeah. You've got newspaper articles there stating that, strongest recovering market in Australia. We're starting off a low base. It's easy to claim that.
Yeah, you don't need a lot of change to
Yes.
change the stats, but it's also got one of the best construction grants,
Yes.
government grants. It's very, very attractive. And so some of that data is being skewed by those new house and land packages
Correct.
that are being built. And so once again, ground truth.
Yeah. So, just for relevance, like even with myself, with my portfolio there, because of those grants, I've actually brought forward my construction to take advantage of that. So there's a lot of people that have done that. So that's created that spike in data. Then we've also got, obviously, the fly-in, fly-outs that are choosing to rent locally rather than come out of state, because when they go back in, they got a quarantine.
Well, they have no job to go back to because they're not allowed back.
That's right.
Yeah.
That's right. Yeah. So you need to take those into account as well before you look at saying that, this is a market that's absolutely taking off. No doubt it is moving. And this is where also where you need to focus on the right types of properties, like you said, the largely owner-occupier areas and not your traditional investor-driven areas is where you'd look at, because when the fly-in, fly-out start getting out, okay, there's a natural reduction in the demand. Also, it's really nice and rosy right now, but like you said earlier, we need to look at what the normal reset is in these areas. Like this is not just Perth, this is every area looking at. You need to look at it from a historical point of view, not in isolation with COVID and the cheap money that we've got and the fact that we're saving a lot of money right now, so therefore we're pouring it into investments and real estate purchases. So take all of that away. What's the trajectory in that area? What's the liquidity in that area? Because as we are getting into property, we also need to be looking at how do we get out of this transaction if we have to.
Which comes back to that commentary earlier on about a liquid market from
Yes.
either side, buyer or seller. I think they're probably the main markets. We could probably spend another 4 hours talking about those smaller areas and different states, but we won't. Let's get to the subject, which is that balance between, the holy grail of balance between cash flow and growth.
Yep.
And the first thing I want to say or talk about in terms of that is that it's an absolute necessity whether you think so or not. It will change as time goes on. So if you're a little younger and got no real responsibility other than yourself in life, well then your risk appetite, therefore your cash flow position, may be a little bit different from when you're married with kids or maybe even towards the end of that journey, the transitional stage into retirement where maybe cash
Is more.
or maybe growth as well, but depending on the person. So it's absolutely imperative that you go into, you create a portfolio with your eyes wide open. It's not about the best case scenarios. It's about what is the norm and what is the worst case scenario, because everything above that is a bonus and is the wealth position. So the difference between, before we go into it a little further, let's talk about the difference between cash flow and growth. So there's this, the narrative around either, there's two types of investors. There's your cash flow investor or there's your growth investor. And typically the cash flow investor is chasing the positive cash flow properties, which the rule of thumb is the growth may not be as
Important.
well as strong. Yeah. And because usually that's a regional area, that's not a city metro area. The majority of the population doesn't live there. The majority of the jobs creation isn't there. And so it's a risk reward scenario. And then there's the growth investor who's, don't worry about the cash flow, focus purely on growth within your means, because growth is where the wealth component is. And they're traditionally a higher priced asset or ticket with a lower yield. But the general narrative, I was going to say rule of thumb, but I won't because I don't buy into it. The general narrative is that they'll grow faster as a percentage, more so than areas that are 20, 30, 40 kilometres outside of the CBD. And in a nutshell, they're your two types of investors. Cash flow or growth.
Yep.
Whereas we think you actually need both.
We do.
And you can have both. It's just the way that you approach it.
Exactly. And so this is addressing both sides of the equation, right? So when most people get started or looking to get started with investing, they are strongly focused on one camp, whether it's capital growth. So I want, good growth. I want to buy as close to the city, or I want to buy in Sydney. I want to buy in Melbourne because there's got really, really huge growth because that's what it's done historically. But they're looking at it from an anecdotal point of view. They're looking at what the books are saying and not relating it back to their own personal circumstances. So as an example, if you've only got, say, $80,000 and your borrowing capacity is, say, $350,000, that largely rules you out of Sydney, right? In most cases, unless you went regional or unless you went units, as an example, right? So obviously that determines where you need to land. The other side of the equation is cash flow. A lot of people start with, I want my portfolio to be positive cash flow from day one. And that even though they may be earning good money, one of the things we advocate and one of the first questions we ask when you contact us to start your investment journey is to ask how much per week can you put aside towards your portfolio.
The shortfall.
The shortfall. Because that will then help determine and shape your portfolio, where you buy, where you get started. Because there are three things that drive it. One is your shortfall capacity. The second is the amount of capital that you've got. And the third, of course, is your borrowing capacity, right? If you've got, 200,000-300,000 sitting there in cash, but all you can borrow is 100,000.
It's irrelevant. Yeah. And that's a really important point because cash flow and capital are your two finite resources. They only go so far, so you need to look after both of them. And in terms of the borrowing capacity, and I think we might have mentioned this last podcast, there's two types of affordability. One is what you know you can afford.
And
like
the other's
you
the bank,
know what you can afford. And the second is what the bank is telling you that you can afford. And sometimes they're wildly different, especially for those self-employed people and depending on how you derive your income. But it's always important that you look after those two bookends of cash flow and capital, equity, whichever way you want to slant it up. But it's also, you mentioned the shortfall, and affordability for me comes down to the eye of the beholder, so to speak. So there might be advisors out there that say, well, 3.5% or 4% is a cash flow deal as a gross yield, and there'd be others that say that that's ridiculous. That's a hugely negative property. 6, 7, 8% net is a cash flow deal, and both camps are.
They're right.
They're right. It really depends on the area. So an example of that would be if in Victoria, Melbourne precincts as such, I'm being quite general here, but if you got a 4% yield down there, you'd
be turning cartwheels.
You'd group hug and high five and you'd think that was awesome. But so that would be a cash flow deal, high cash deal opportunity. Whereas in a lot of sectors of the Brisbane market, that would be normality.
Yeah.
Or even a little low in some cases in terms of its cash flow proponent. And the Sydney Basin is somewhere
in between.
Whereas, say, the Perth market, that's a wildly different market because today you could scout around and get your 4.5% yields, but if the prices keep accelerating the way that they are and rents don't keep up, well then suddenly...
We're back to where it was 3 years ago at 2%.
Correct.
Yeah.
And so it's also, so therefore it's dictated by the time in the cycle of the market, but also each state and what they determine amongst themselves and their narrative on what is cash flow. But somewhere in the middle is that sweet spot.
Yeah. And what we are not saying for a second is that you need to focus on just the one side. We need to focus on both sides of the equation because they're just as important. Even if you are earning a strong income, what you need to do is set up the portfolio so that at the time that you need to amplify the cash flow, you can actually do that. So a good example of it is when we set up portfolios is we planned quite deliberately to get one or two granny flat sites or multiple dwelling sites into the portfolio for that eventuality that, okay, at some point in time, I want to turn my portfolio around into neutral or positive. And that would be a really easy way. So you're holding a capital growth portfolio, but it's got the ability to turn it totally around, especially when rates start going up as well.
Or even down. Because as you were saying that, I was just thinking about some of the portfolios were created around different parts of, say, that Sydney Basin area from yesteryear.
Yes.
Where we may have controlled the opportunity that had the chance of multiple streams of income. So a secondary dwelling to create that next rental income stream. But we didn't execute that opportunity straight away.
Yep.
Like, so we controlled the property, but we didn't create the additional revenue straight away until the time was right and all those numbers added up. So whether that be construction cost, whether it be vacancy rates at the point of time and the cost of money, so i.e. now.
Yeah, and the convenience factor as well.
And the convenience factor, because you have to ask yourself the question, should I chip in here to build, or should I actually control another asset in a different area for diversification? So when we say that you actually need both, so you need cash flow and you need growth, we say that because we mean it. It's a necessity to have both. And we call that balancing the portfolio, or even in some cases, pigeon pairing, as we've talked about before. And what we mean by that is there might be a property, we might need a capital injection to the portfolio. So we've taken care of our cash flow positions with prior purchases, but now our capital needs to be accentuated. So we might be looking for something that has the potential of a higher rate of growth, a lesser cash flow, or it might be something that we can add value to. So manufacture value as well as organic growth. And that's a very important point. So that it increases our capital position to be able to recycle, to go again. Because once again, we've taken care of the cash flow by having the money before we need it.
Yep.
Now, that doesn't necessarily mean that's the right way to be every time. It might be a different direction depending on your unique circumstances, where we'll get some growth because our capital position is pretty good. So we'll chase those types of properties first, knowing too well that we're going to arrest the cash flow position within a given period of time.
Yep.
And that's very important, because it's not a, well, we'll wait and see scenario. We have to plan it out. And there are some variances, such as the availability of credit, interest rates, COVID, and the like, that is out of everybody's control. But if we control the opportunity for the future, then we can execute when necessary.
Yep. I think the most important word here is controlling the opportunity, right? Because that's what we need to do. And part of a good portfolio and part of a good portfolio process is to have regular reviews to see where the position of the portfolio is. How does that match up to what's happening in career, life, economy? All of those things to say, okay, do I add to this portfolio? Do I change deck now because I've got a bunch of good cash flow properties? I'm not saying positive cash flow. I'm saying good cash flow properties. And because I'm still within my affordability range and I can still qualify for finance, do I now go for a large capital play to then now offset these slower growing properties with a fast growing property? So you've got the best of both worlds now.
Well, when you're investing for lifelong goals,
yes,
the planning process never stops.
It does not.
It's continually adjusting. And this is, as a side note and maybe a soapbox scenario, is around those longer term goals. And
they can't be set in stone, can they?
No, and therefore nor can the strategy.
Yes.
Or the plan, because there's too many variances that you haven't even encountered or even thought of yet. So the portfolio, no matter what the asset class is, shares, pencils, bananas, property, whatever it may be, needs to be created on a foundation of growth, cash flows we're talking about, but also flexibility.
Yep.
Otherwise, you paint yourself into a corner, and Murphy's Law will kick in, is when you paint yourself into that corner will be the worst time, because the whole economy is experiencing that same moment in time, and yet now you've got no flexibility.
Yep.
Great example of that would be, I think we've used the example for way back in the GFC days, and we often talk about those that controlled their cash flow, controlled the asset.
Yeah.
Now, I'm not talking about cash flow positive properties, their cash flow, their unique circumstances. So those that controlled their cash flow position are now reaping the rewards of 300% asset growth in terms of its value position. Nobody lost their property from a lack of equity at that point in time. It was from a lack of cash flow management. Now fast forward to the this sea change.
Mm-hmm.
Did you see someone?
Yeah, someone did.
Yeah,
Actually, they did.
Finally, it's. I've been trying to. For anyone that's new to the podcast, ever since COVID started, or very early on the pieces, I've been talking about the sea change, sea for COVID change, not the tree sea change, and trying to get it up off the ground. And I noticed, I don't know who it was. I think it was somewhere in Domain or realestateinvesting.com. Someone called it the sea change. I said, yes, I'll take that. Anyway, small wins. But if we fast forward to the COVID scenario, and in those initial stages where there was fear and pandemonium, and for good reason, around health, death, plague, and everything like that, but how it's going to affect asset classes.
Yeah,
there was a moment in time where those that did, and those that didn't are now saying, "I wish I coulda, woulda, shoulda."
Yeah, yeah.
And that's a historical approach. It's happened every single crisis, and as another side point, there's always some sort of a crisis.
Yeah, yeah.
Always.
If you look back at 2019, there was a crisis there, which was the lending crisis. Yeah,
correct. And then there was elections prior to that, or after that. So on.
Look, most people when they're investing, or they look at investors that have been very successful, they say, "Oh, you've been lucky. You started so early, or you bought at a time when the prices were low." You fast forward today, 20 years down the track. You look back now to the prices now, you'll say, "Geez, those prices were very cheap," right? If the trajectory remains true. Which it generally does. So the true investor invests during the good times and also invests during the bad times. What changes is their focus on the type of property that they're buying, and where they're buying and what they're doing with their portfolio at that point in time. That's the change that needs to happen so that you can make the best of the market as it is.
Which means that we're not even our strategies aren't set in stone. They're created with a degree of flexibility for moments like this where we can, as an example, the banks are willing to give us more money. And they're not me, but I'm just throwing it out there. So they're willing
is that a cry for help, Steve?
No. It's but any of the big four if you're listening. But if there's a moment in time where credit has become a little easier to get, and we have the scenario that we have today with cheap money, potentially better credit, a perpetuating market,
rising rents,
which means undersupplied, et cetera. Well, then our flexibility within our strategy should enable us to be able to exploit some of the opportunities that we find today, which might be more about growth.
Yep. And in the last podcast, we talked about how your negotiation and your approach towards buying property changes in markets like this, where it's not necessarily anymore about how much you can smash down the listed price, because most properties are going above the listed price at the moment, right? So it's about controlling the opportunity and making sure that your offer has got less terms and terms that are more acceptable to the vendor as opposed to the other punters out there. So it's all about knowing how to change your offer proposition to control the opportunity.
It's a good point. It's about how you change your negotiation strategy to control the opportunity.
Yes.
Because what works today is clearly different from how we approach negotiating back in, I don't know.
Even 2 years ago.
March, or even 2 years ago in a sense. And so that's why some of these books about the art of negotiating and everything like that's a bit in your face, because it's an evolving process as well, and especially because of technology and the like. So if we come back to the balance between growth and cash flow, and what would be the number one proponent that you'd be looking for in terms of cash flow?
Consistency of rent, right? Because it's all good to buy a property that's promising all the rent, but if you haven't got the consistent tenants, or you have strong turnover of tenants, then your cash flow on paper, it does not translate to cash flow in real life.
Yeah, 100%. So you pass.
Lucky that.
I know, right?
Question without notice, sir.
I know. I saw your eyes. It was like, what are you throwing me here? What are you throwing me here? But that's the truth. It's about the consistency of cash flow. So when we're talking about this balance between cash flow and growth, cash flow also, and probably more importantly, involves your cash flow.
Mm-hmm.
So cash flow control around your
Yep.
household budget and your
How much
unique
is left over?
circumstances. Yeah. Which part of that is the consistency of cash flow, whether that be from the asset, because we decided not to be greedy on our asking rent and kept it at market, and it was consistent without the changeover of tenants or excessive repairs and maintenance because you have been greedy on the rent, or it might be the consistency in your job.
Yeah, income.
Your own personal income, or it might be expenses. So the thing about cash flow is everybody always thinks about income,
Yeah.
where there's an equal portion of expenses that is probably just as important.
Yeah,
if not
you got to
more
see
important.
how leaky your bucket is, right? You need to make sure that you start plugging the leaks that are not, the holes that are not necessary in the bucket. There still would be some money that will go out because you got to live life, right? It's not, if by investing you've got absolutely no life, no social life, I think that's the wrong approach. You're going too far in. So you need to perhaps re-look at it and say, okay, do I rationalize my portfolio so that I can live life without resenting my investments?
It's a good point because a lot of people do.
Yeah.
A lot of people at that point in time, in their beginning stages, people are willing to sacrifice. Then they get to the stage of resentment.
Mm-hmm.
And if they push through that and they haven't gone too far, then at the end of the journey, it's like, yeah, well, I did the right thing.
Yeah.
And I'm glad I did it that way. But don't go too far.
Mm.
Yeah, still go out and enjoy life and buy a Bentley or...
There you go. You got it.
I got it again. That's my New Year's resolution. It wasn't like around the portfolio. It was how many times can I mention the car? People probably going, does he have one? Who has one?
It's a toy one.
Is it real? Yeah.
No, it is real. Hardly used.
It's real.
Going really cheap if you want to buy it.
Really?
No.
I wouldn't buy it, but I know someone who does.
Yeah.
Bentley drivers, you're all the same. So once again, it's about cash flow management, not so much cash flow from the asset. And that consistency point, also, they have a flow-on effect. Cash flow management has a flow-on effect, not just necessarily to that moment in time, but as far-reaching as serviceability and borrowing, and then the ability to be able to add to the portfolio, whichever the asset class needs to plug and play. So then if we talk about growth, I'm going to go the same question. What's the biggest proponent for growth for you?
For growth, it's the not relying on consistent growth to say that it has to go up by this much each year, right? So your projections is what you're trying to get away from, because understanding that the growth is pretty much cyclical in nature, right? So if you look at Sydney and Melbourne, traditionally trough to peak is 3 to 5 years, right? However, when I bought my first investment, Sydney had not moved. This is back in 1999. Sydney had not moved for 12 years. So it had flat growth for 12 years. And then, of course, because I bought it, caught up. Yeah. But that's what we need to look at is staying away from your... if I can bring Port Hedland into this, right? So a lot of people got hurt there by speculating on the growth there, because the growth was because of the lack of supply, but it was all tiered to what the mining was doing. So you need to go back to underlying pushes of growth to make sure that the capital growth that you're getting is in line with consistency in that area. It's not out of character, because if it's out of character, you need to look at what's the catalyst that's made this. So that way you're not speculating in that area. And then when you look at it from a capital point of view, one of the key mistakes most people make is saying that I want to control $5 million worth of property because it'll give me 5% yield and therefore I'm set for life. That sort of thing doesn't quite work that way.
It's a good point, because I think the metrics have changed over time as well. So if you go back 20 years ago or 30 years ago, if that was even before my time, 30 years ago, that the way that the filter that you put on residential real estate or commercial real estate or even shares or other asset classes for that matter is far different today than it was back then, purely by technology and that instant access, as we've talked about before, to information, education, results driven, the ability to be able to measure performance today is far easier than what it was back then. A simple example is, the CoreLogic, what do they call it? Not value tracker, but the way that they're measuring the micro movements within the market, and that you can track it almost like a share, but not as delicate, if you will, as that. Versus even 20 years ago, where it was a little bit rudimentary in terms of the data science, and it was more about flicking the paper.
I remember hanging out for the property magazines to come out each month, because you'd look at the back of the magazines to see how much your suburb went up by.
And that was even out of date before it got to you, because it was 5-6 months old in some cases. But it was walking the streets and physically monitoring each individual suburb and house and street to see what's sold, so that you could get an idea of what the value is. So typically what investors did is it was out of sight, out of mind. And they concentrated on the pay down, which is fine, and the cash flow, because that was weekly, as opposed to the value. Now things have changed because of our ability with technology to be able to measure, implement, refine.
And a lot of free valuation tools, in inverted commas, on the net, that you can say how much my property is worth as well. That plays with people's minds.
Without a doubt. Every week I would have an instance where it says this, but it's that, whether it's up or down. So technology, and you also mentioned about the peaks and troughs, or the cyclical effect of the markets. I would say that the distance between the peak and the trough now is far shorter than what it used to be, once again, because of education, information, realistically, all because of technology.
Yeah, everything's become faster because of technology.
It's a faster paced world.
Yes.
Everything is, and it will continue to be so. And I'd probably say into the future, I'd almost see that there's a trading platform as such, but it won't be. We'll call it a data measuring platform that will actually intrinsically start to measure our asset class in a much shorter period of time than it is even today.
Yeah.
And there already is traded futures and things like that on it, but it will become more the norm. And it'll be almost like a fractional investing platform that we don't even know exists today.
Yeah.
But some data boffin in the background is thinking about it already. So the growth is our wealth. That's our long-term. That's the long-term effect. And there'll be moments in time where we will we'll sacrifice, fairness, if you will, to see what those growth components are and to get a bigger piece of the pie. That's just human nature, or speculation, or increasing your risk profile for that given point of time. Because to be fair, a younger person has a lot more time in their sleeve to take care of the mistakes. Like, I think about the way that I approached investing 21 years ago is different than how
Vastly
I do
different
it today.
Yeah, because there's several factors that play in, right? One is age. When you're getting very close to retirement now, Steve. The other,
you get free transport now, don't you?
RSL. The other factor, of course, is that now you're controlling a lot more assets, right? So what you add into your portfolio and what you do to your portfolio, it needs to be very, very thought out. Along with the fact that as your portfolio increases, the finance starts to become a little bit more difficult. It becomes a lot more involved. So the bank takes longer to get you finance.
Yes, it does.
So when you look at those sort of things, yes, as you progress in investments, your approach, how quickly you make decisions, do change, faster and slower. But you also need to be reminded of, if you're going back to the capital growth position, just like rents going up, down and sideways, so does the capital growth. You're not going to get consistent growth every year.
It's not a linear approach.
No.
To anything, to whether it be cash flow return and growth, or whether it be the equity positions growth. We might have runs of time which are longer than others in terms of that growth cycle. But conversely, we also might have times of zero growth.
Yeah.
We might even give a bit back and then have sideways growth for some period of time, which usually follows after a vertical moment in time of growth.
Yeah.
So when you have amplified growth, well and truly above reasonable historical average moments or growth patterns, there has to be an element of change in the market to get it back to somewhere near those historical patterns of growth. There will be exceptions to the rule, no doubt, but generally speaking, you can't have vertical markets. You can't have double-digit growth year on year,
not sustainable,
year out forever until you reach that point of, which we're already starting to see it now, and we told you so, is around the narrative around affordability.
Mm-hmm.
It was only 5 months ago, and I'm going off on a bit of a tangent here, it was only 5 months ago or thereabouts that the media and the institutions were talking about this is the most one of the most affordable moments in time in a long time. And now some of the media outlets are starting to talk about this affordability issue that's starting to creep in to some of the markets.
That's true. And if you look at so one of the questions we get asked is, when was the best time to start, and especially if you're starting from scratch, right? And I dare say, and I'm putting my sticking my neck right out over here, I dare say that now is probably one of the times to get started. When you look at it from a point of view of, there's going to be fairly strong growth in most areas. Rents are creeping up. Finance is easy. And so the only thing that's now missing is finding the properties.
Who'd have thought that would have been an issue. It's so we'll replay this podcast
in 10 years' time.
In 10 years' time, that's a pretty safe.
That's a safe bet.
It's
no, in fact, in 2 years' time, let's come back and check in 2 years' time to see how things track.
Well, I think we've already done that. We did that. This time last year?
Yes, we did.
Or even March or thereabouts. We said we think it is going to be one of the best sweetest times in reasonable history. And it has been.
Yeah.
And it will continue to be so. It has actually, and I was speaking to a client the other day about this, it has the same vibe as back in 2001, 2, 3.
Yeah.
It's the very same vibe.
Yeah.
Now, I don't know if the results of the market will be the same, because back then
it was almost doubled.
Well, I did have some properties that doubled in 12 months, and I do not think that's going to happen. Right? In fact, I know it's not going to happen. So let me make that really, really clear. But the vibe within the market is very, very similar. And back then there wasn't the platforms or the ease to perpetuate that vibe, feeling. Yeah. Do you know what I mean? Like today it's in every...
It's amplified.
It's amplified today because of technology once again. Back then it was word of mouth. In fact, and I've often...
I recall the days of meeting up in pubs, secret societies.
It was like a secret society like nobody talked about. It was like, you're an investor, really? It was all sort of...
Because it's unusual, right?
It was not the norm.
Yeah, and to find properties, you waited for the Sydney Morning Herald on Saturday because that had a property section, and also your local reg, which had a real estate section, and they were the only places apart from the real estate windows.
The good old days.
Yeah, and when you walk into the real estate agent, they say, okay, what else have you got? And out would come the Leverage files with them flicking through. I've had this for 4 months now. It hasn't moved. And
it would have been in the slips, in the those little...
the sleeves.
The envelopes or whatever it was, and you'd sit there flicking through them. And I really enjoyed that back then.
It built rapport. It was easy to build rapport with the agents, and you found the motivation.
Well, it was also, I found it was not so much an easier time, it was more truthful.
They couldn't bamboozle you with data.
Correct.
Yeah.
And so you knew every street, every house on every street, every house on every street, and every suburb that you were in that sold. It was physical ground truth. In fact, for me, I'm glad I went through that, because I carry that through to today, and so does our whole entire teams.
Yes.
And that is around ground truth.
Yeah. So that way we can interpret the data with the ground truth and make a formative decision as to whether it is something that's going to be trending, or is it just a flash in the pan.
That's a good point too, because there are certain markets that are trending markets, and that sounds like a really obvious point, but it's not. There are trends that have sustainability and are long term,
and they're transient ones,
and then there are transient trends. And if we bring that around the whole growth cash flow scenario, if you talk about maybe the central coast of
Yes,
the
sir.
Sydney Basin and the south coast of Sydney Basin, that's a trend, but it's a sustainable trend.
Because
And
the
it was-
underlying trend was there.
Correct. It was there before COVID started. And then there are trends where, in my opinion, will be short-lived. I don't know what that time frame is.
Yeah.
It could be 1 year, could be 5 years, but I see there being problems in the future. And these are some of those subpar regional areas which are purely lifestyle-driven without any fundamentals behind it,
Yeah.
any economy drivers, jobs growth, et cetera, et cetera, et cetera. And so there might be some people getting stuck there. And that's actually a pretty good example of when you're chasing cash flow for all the wrong reasons.
Yes.
So it's a good cash flow. Well, it's a potential on the surface good cash flow hit now. And there might even be a little bit of growth because the trend is pushing it that way. But are you going to be in an illiquid market in years to come?
Yeah. You got to look at it medium to long term, right? You can't invest for the now.
Unless you're a transient investor.
Yeah. Oh, yeah, that's right. And if you go back to our last podcast, we went through the various types of investors that you had coined, which was...
I have. Did you like them?
Yeah.
I've actually, and I did write them down. Do you want to say them again? I'll
Go
tell
for
them
it.
again.
Go for
All
it.
right. So there's the value investor, which is what I believe we are.
Yes.
It's always value. At the root of everything is value. There's a contrarian investor. Then there's the growth investor. Then there's the growth stock investor. So that's almost like momentum investing, which is the next one. And at the moment, there's probably all of those types of investors in the market. And at one point or another, we probably all have a little bit of that in us as well. But that very much shapes the market because, and I'm going to come back to technology again, is everybody today is far more entrepreneurial than what they were back in 2000.
Correct.
Right? In mass, thanks to technology, the way that we can educate ourselves, the way that we can learn and transact.
And also the availability of finance, right? So if I go to the yesteryears, to begin with, if you needed money, you went to the bank manager and they had to know you and give you a ticket for, yeah, I know your parents, you got from a good family, we'll give you the money. If you are a female, good luck, right? Because they didn't lend to females unless there was a male involved in that transaction. So that's now changed to money is as easy as clicking a button these days, provided you tick all the boxes.
As long as you tick all the boxes, double income, no debt, no kids, essentially.
So go on other bank manager days, it is now managing your credit history and managing to find the right lender to begin with.
And that's actually an important point because managing your credit history ties in with cash flow management.
Correct.
Now, cash flow management, and we're coming back to the subject here after we deviated
As
as usual. Part of cash flow management is credit management. And part of cash flow management is in your own circumstances being liquid. So not finding the liquid market, which is on the growth side of the ledger. It's about you being liquid all the times. And that might be something as easy as, said than done, it could be easy as releasing equity
Before you need
it.
it. Yeah. Because lending could
it.
change tomorrow. Lending criteria could change tomorrow. The
Correct.
market may have perpetuated so high, APRA steps back in and says, you know what, back to 2019 blokes. And so we then can't borrow again. And you've got all this massive equity that's sitting there that you can't access to take advantage of opportunities that will come at that point in time. So that's why we always say, keep your equity liquid.
And that's part of personal cash flow management.
Yep.
At the end of the day. So I want to also go now back again to the whole point about people are far more entrepreneurial because that is going to drive growth today. And it's because of technology, et cetera, et cetera, et cetera. Is that as long as there is an internet connection, you could be in the jungles of Panama selling widgets before you've even
For a moment, I thought you were talking about farming in Panama, in the jungles of Panama.
No. But that's it. Like you could be drop shipping or whatever they call it and turning $1 that way from maybe a potentially very lowly educated community. It's now getting a piece of that mindset has enabled everybody to be able to forward themselves. And how I relate that back to our asset class being real estate is now people know what is possible. they've got all that data, they've got all that history, they've got all that education at their fingertips to hopefully then make informed decisions going forward and know what is possible. Then overlay that with credit and the ability to be able to get it in today's cheaper ecosystem, if you will, is amplifying that position, but by the tens of thousands of people, which will then equal tens of thousands of transactions. And that means growth. It can be that simple.
Yeah. And while you're saying that, you mentioned information and how information was hard to get in the yesteryears, right? And technology's changed things. Here's how 180 it's become, right? Back when we were investing, late 90s is when we started, early 2000s. The rhetoric was, I don't know what to do. Where can I get the information? Right? Now it is, I've got too much information. I don't know what to do.
Yeah, where do I start? Where's the good information? How do I decipher that? And that can very quickly morph into an analysis paralysis, which I see more and more people becoming a victim to. But equally, I see people becoming a victim to FOMO.
Yes.
In the market as well. And so as long as you've got the right education, the right information to make those informed decisions, well, then you should be off to a good start. And think of it as the long-term asset class that it is. And the reason I say that is because you're going to start to see many success stories.
Yeah, absolutely will. Yeah, I think they're already popping up.
Yeah. And it seems like they just started yesterday and they're already a quadrillionaire. But that's not the norm.
Yeah.
They might have had a bit of luck, good on them. They put it out there and they succeeded. But equally, there'll be just as many sort of car wrecks in the future. And then you'll start to see the media programs start to focus on that. So as long as you stick, and the fundamentals as we all talk about, but for good reason, as long as you play within your lanes, and sometimes those lanes are a little larger than others, and that you make informed executive decisions, you'll be okay for the long run.
Yeah. So investing is like, I bring an analogy. It's like the African bamboo, right? So the African bamboo, when you plant it, you got to water it pretty much every day. For 5 years, it does not even sprout out of the ground. Then overnight, it springs to 7 meters, right? In the 5th year, it springs to 7 meters. You can Google it. And this is what investing is. A lot of people look at the overnight thing and say, bang, yes, it grew by this much. But they forget the 5 years of nurturing that had to happen to get to that growth spurt. And a lot of times, this is what property is. We become too impatient to see that result in the end, or the big growth, because you're already seeing someone else's growth. So what you're not taking into account is their 5 years of watering, and you haven't done your 5 years of watering in that sense, right? So equally importantly, with that, taking long term into account, this is where you also don't speculate and say, if it's not the right property to buy right now, it'll be okay. It's long term, it'll be okay in the end.
Good point.
So
we're running out of time, but there's one more really important facet in terms of that sweet spot between growth and cash flow, and that's portfolio management.
Yes.
Now, and I don't mean the property manager; they're just a piece of the puzzle. I'm talking about your own portfolio management, continually assessing the income, the expenditure, the growth position, how to add growth or equity.
The fine-tuning.
To it, fine-tuning, if you will. And even more so now, it's just as important as when we have a subtle market, as we call it, where there's just normal growth or maybe even a little less because of the circumstances beforehand. Now's the time to be able to capitalize on that position. So whether that mean adjusting your unique scenario around your cash flow, being your assets or your personal income, to enable you to be able to borrow, therefore to become liquid, do it.
Yep.
If it means that you could do a renovation to amplify its cash flow or its growth position, do it. We want to be in a position that at this moment in time, where we've got all the cards in our hand, that we don't squander them. Simple as that.
Yeah.
So what do we do for the portfolio management?
So pretty much, it first of all, we address the goal, right? What are we aiming for? Is this portfolio relevant? And what do I need to do in terms of its management? Do I bring forward a construction because we can predict that in 2 years time, we're going to come to a cash flow cliff? So it could be something as simple as if we look at the 2019 scenario, a lot of our clients, we prepped for that because we could see that they won't be able to turn it back to interest only. Right, so a lot of the clients we reviewed, we said, bring forward that granny flat construction, create that extra income, get rid of your leases.
Have the cash before you need it.
Yeah, exactly. Yep. Push up your rents. It's amazing how people don't push up their rents in time, and when you're too far back off the market, it's very hard to increase that all at once. Right, so you are impacting cash flow, you're impacting your serviceability as well, in able to qualify for loans. And to get back to market, you may have to get rid of the tenant and get a new one, which would require a capital injection because you need to then give
it a paint and a carpet,
that's it.
And suddenly you got 2 years worth of increased income.
Correct.
Already spent.
Yep. But in a review situation, we're already flagging this to say, okay, this is the consequence of doing this now. Your rents aren't up to date. Insurances, looking at making sure that the properties are insured.
Interest rates.
Yeah, interest rates. Interest rate's a big one. Interest rate's a
huge.
big one.
There
right?
wouldn't be a week go past where I'm not sitting with a client doing that review where someone is not paying massive overs.
Yeah.
And what's massive overs today was market normality 5-6 months ago.
Yeah.
Yeah, there's a much more aggressive lender out there, and if it means that you should be moving lenders to capitalise on that income position or that extra income position via decreased expenses,
people don't
do
like
it.
change, right?
Well, I
That's
don't think
the
they
thing.
like the work
That too.
because it's a hell of a lot of work
Paperwork.
to change lenders, and that's why for mine brokers are worth their weight in gold because I couldn't do that job. The detail that's required is just next level. So taking advantage of situations while you can is imperative because you don't get these opportunities very often.
No.
Like
This is a very unique time.
This has been literally, I'm going to call it 18 years in the making. If I go back to my commentary around, this has got the same vibe of 2001, 2, 3. This has been 18 years in the making since it's been, well, I believe, this good for all the moons
To line up.
to align. But that's part of portfolio management, and it absolutely bewilders me how people can classify property as a set and forget asset.
It's not.
It's the furthest thing from it. And if you're only visiting your portfolio once every couple of years, with a really focused filter, you'd be an idiot.
Here's an easy one. How often do you service your car? Maybe you just line your portfolio servicing to your car servicing.
And do you self-service the car?
Oh, yeah.
Well, actually, I do, but so investment portfolio management is it's a blend of art and science.
Yep.
In my opinion, it's not something that you can just brush over and think that you're getting the best out of your asset class. It's a blend of art and science, and that art and science will be dependent upon the strategy that you deploy initially and how that pivots along the way to suit your personal circumstances at that point in time. Because as we mentioned earlier, your risk profile, your risk appetite is far different when you're 22 or 25 than when you're 55, and so it should be.
Absolutely. You're running out of time. Literally, in this podcast as well.
I thought
that was a good segue.
I thought we don't edit, Vic, and you're telling me to be quick at the end of the podcast. Like literally, we do not edit. It's
Yeah, that's true. That's true.
But you meant my age.
That's it. Yeah, that too.
See, now you got me
It was a double-edged sword.
right.
So,
Just saying, you're older.
only just.
Well, if you call 10 years, just. All right, I'll take your hint. We're done. So that is the fine art of balancing cash flow and growth. And if you're struggling with that and not knowing what it means to you individually, as always, feel free to reach out.
Yep. And also, if you haven't liked or followed our Facebook page, go and like the page, because every fortnight we do a Facebook Live where we cover different topics. And if you like or follow the page, you'll be notified when we go live.
And if there's also subjects that you want us to cover in these podcasts, feel free to give us an email.
questions@rightpropertygroup.com.au.
I was looking at Vic then saying, what's the email address? It's questions@rightpropertygroup.com.au, because for us, this is everyday topic for us. We talk about it almost 24/7. And so sometimes we would like a little direction on what you want to know about rather than what we want to talk about.
Mm-hmm.
So once again, thanks for listening. Please give it a rating, thumbs up, thumbs down, be truthful. And we will be back in a fortnight, this time with Phil Tarrant from Smart Property Investment Magazine. And there'll also be a podcast following that where we do a portfolio review, Phil and I, on the portfolio that we created for him many years ago. 10 years ago. Well, there it is. So that'll be some interesting listening as well. So up until then, we'll see you next time.
See you then.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.